Hi everyone and welcome to this video where we will be getting some more practice with adjusting entries. So let's look at this together on the computer. Sweeney and Allen, a large marketing firm, adjusts its accounts at the end of each month. The following information is available for the year ending December 31st. So we're given a series of 6 transactions, and our job in part A is to record the necessary adjusting entries as of December 31st. All right. Part B is asking us a question about net income. That's not really useful for us. What we want to do is get practice with adjusting entries. Let's forget about B. For your purposes, we're going to ignore B. All right, so I'm just going to eliminate that. And let's go through these one by one and just prepare these adjusting entries. So number one here, and I'm just going to put some formatting on this so it's easy to read. All right, so number one, it says a bank loan had been obtained on December 1st. Remember, we're doing these adjusting entries as of December 31st. So bank loan at the beginning of the month, accrued interest on the loan at December 31st amounts to $1,500, $1,500. No interest expense has been recorded yet. So all that we have to do here is debit interest expense and credit interest payable. And the amounts will be $1,500. All right, so I am going to once again do some formatting. I'm gonna make this a number, and I don't want any decimal places. Okay, and then I forgot to capitalize the I in interest, so I'm just gonna go back and fix that. All right, and let's center these amounts just so it looks nicer. Okay, all right, so that's the answer to number one. All right, so debit interest expense, credit interest payable. Number two, it says depreciation of the firm's office building is based on an estimated life of 30 years. The building was purchased 4 years ago for $450,000. All right, so what do we do in this one? Well, we just have to record depreciation expense. So depreciation expense, we're going to debit depreciation expense. And we will credit accumulated depreciation. All right, well, now the question is how much? How much should we record? So the amount that we have to record is the amount of depreciation for 1 month, because Sweeney and Allen, they adjust their accounts at the end of each month. So we need 1 month of depreciation expense. Well, how do we get 1 month of depreciation expense? Well, if you remember, the formula for straight line depreciation, that is equal to the original value of the asset minus its estimated residual value. So what we could get if we sold it for parts at the end of its life to like a scrapyard or something like that. And we're going to divide that whole thing by its estimated useful life. All right. So in this case, our calculation is going to be equal to the value of the asset. They said the asset was purchased for $450,000. So we're going to say, excuse me, equals $450 or $50,000. They don't say anything about residual value, so we'll assume 0 for that. And then the estimated useful life is 30 years. And so this will give us depreciation per year. And so let's calculate that. We're going to just grab our calculator here. We're going to say 450,000 divided by 30 years. That's $15,000 per year. Because this 30 that's 30 years. That is the estimated useful life. All right, but we have to record depreciation expense for 1 month. So what we want to do is multiply 15,000 per year divided by, or multiply that by 1 over 12 months. And if we do that, if we divide 15,000 by 12, we get $1,250 as the monthly depreciation expense. All right, so our amount here is 1,250. All right, number three. Number three says accrued but unbilled revenue during the December amounts to $75,000. So here we're going to say debit accounts receivable and credit. We're going to call this, what are we, a marketing firm? So we're going to call this marketing revenue earned. And the amount will be $75,000. Okay, that's number three. Number four, on March 1st, the firm paid $2,400 to renew a 12-month insurance policy. The entire amount was recorded as prepaid insurance. So what we have to do is record the insurance expense as we use the policy. So we're going to say debit insurance expense and credit the asset prepaid insurance. Now, for how much? Well, the policy was so the insurance expense is going to be equal to, the policy amount was $2,400 and that was to cover a 12-month period. So the per month cost is $2,400 divided by 12, which is $200 per month. Okay, so the insurance expense here is $200. We've got two more and then we're done. Let's look at number five. Number five says the firm received $15,000 from King Biscuit Company in advance of developing a 6-month marketing campaign. The entire amount was initially recorded as unearned revenue, and as of December 31st, 9,000 of that had been earned by the firm. All right, so now we have to reclassify unearned revenue, which is a liability, to earned revenue, which is an income statement account. So we are going to debit unearned marketing revenue, and we will credit earned marketing revenue. And the amount here will be equal to the 9,000 that they give us in the problem. We don't need to calculate anything for number five. And finally, number six says the company's policy is to pay employees every Friday. And since December 31st fell on a Wednesday, there was some salary that was owed as of December 31st. It hadn't been paid to the employees yet. So in this case, we're going to say debit salaries expense and credit salaries payable. And the amount they give to us, again, we don't need to do any calculations. It is $1,900. All right. Now, part B here was asking, by how much did Sweeney and Allen's net income increase or decrease as a result of the adjusting entries in these 6 entries? Well, it's not necessary for us to understand adjusting entries, but if we wanted to, we could answer part B. We could say, well, for one, we had a $1,500 expense in this entry. We had a $1,250 expense in this entry. Then we had revenue of $75,000 here. And then we had expense for $200 here. And then we had marketing revenue here of $9,000. And then we had salaries expense of $1,900. And so the net impact is a $79,150 increase in net income. So that would be your answer to part B. All part B was really asking you to do is go through those 6 entries that you made and add up the effects on revenue and expense. All right, well, this concludes this video. I hope you found it helpful. Thank you very much for watching. and take care.